Good evening, good evening. Welcome to the show. Welcome to Psycho Silver. My name is Jerome, and I believe we are up to 8 episodes. We're going to keep going. We're going to do an episode every day for as long as we can possibly do. And if I miss one day, then the next day I'm doing 2, because I'm going to be here all the time for you guys, giving you interesting information about the psychology of finance and also about stacking silver, my 2 favorite things to talk about. So welcome to the channel. I do hope today that you're counting your wealth in ounces, and also very importantly that you're holding your word to yourself. Especially thank you for putting on my show. I got a whole bunch of stuff to look at. Once again I had to stop in the middle of my research and say, okay, we're just gonna go with what we got so far, because there's so many things happening. It's crazy. I had to throw half of my research out, really. But the most important thing that I saw happening today is that we did see that the Bank of England decided to pivot. They are changing course. And what that means is that they were on a path to raising interest rates, and they've decided that that's not going to work out because they almost had their bond market blow up. And from what I understand about this bond market is that it's tied to pensions, and even worse than that is it's heavily leveraged into other assets. So in the tweets and the articles we're about to review, there's many people that made the comparison. They said it was almost a Lehman moment. We'll get into the nuts and bolts of that, and I'll show you some articles from people that are really talented and knowledgeable about how all that actually works. But before I do that, I just want to say that this is such a critical moment. We are seeing around the world that these other countries are basically incapable of raising their interest rates, and we're talking about that a lot. And the reason that it's so important is on the other side of the reverse, the counter argument, the counterpoint to raising interest rates is more inflation. And so it does appear that, at least for the Bank of England, who pivoted today, and the Bank of Japan, that has been doing yield curve control and near zero interest rates anyways, they never even try to raise interest rates. They suggested it, and they didn't actually take action on that. They suggested it as if they had the choice. They didn't really have the choice. They couldn't do it. So it appears, at least in other parts of the world, they are choosing, let's call it what it is, they're choosing death by inflation. And inflation is something that we should all understand. There's really only 2 outcomes with this crazy debt, with all the leverage that are in these markets, with the way that this financial system, this is serious stuff. The only 2 outcomes are hyperinflation and mass defaults. And it appears that they do not have the courage for any type of default. And any politician would tell you to have the pension or healthcare system default, because those are the biggest, they're the most likely to default, and there's all kinds of leverage in the system. Well, that would be a death sentence for a politician, right? So we see in other countries, and I suspect it'll be so in America, they are choosing the path of hyperinflation. And so now we just see how long it takes and what kind of obfuscation we encounter along the way. And we watch it all happen. We are gonna be stacking up our gold and our silver, and I can still be convinced, but I also kind of doubt it. I do not. There may be a select few cryptos, but I don't know what those are yet. I don't think it's Bitcoin, to be honest. And so maybe that's something we dive more into in another episode. But let's get into the news. Let's get it. It was such an important day for the average person, for people that are not like us, that are And it doesn't even matter if you're a brilliant financial mind or you know all the definitions. I know when I put on these financial shows, a lot of the language, I used to understand none of it. And I said, I'm going to stick my nose where it doesn't belong. And I'm going to learn about this stuff. But to the average person, I think they see this news and they have no idea how much of an emergency they should feel when they hear like recession, depression, inflation. They're somewhat concerned, but they're more picking up. And this is part of the psychology of finance. And this is part of the psychology of how people are manipulated to trust and distrust at different times. They see this stuff and they're more just listening to the tone of the news. They're listening to the tone of the news anchor or the tone of a headline. And then they decided how much worried they should be. But even then, they don't know what to make of it. And it's really unfortunate because it's not as complicated as you might think, but you have to have the discipline. And in a sense, I think it does take some courage, and you need to have some self-belief that you can look at finance and understand enough of it to navigate the world you live in. And so you have personal finance, and to be a high functioning man, to be a high functioning adult, like you need some personal finance knowledge. But the next step, if you can get yourself in order, that's beautiful. You got to start there. But you also need to understand these world events. You have to understand what's happening locally and globally to become a leader, to become someone that can help others, and to even be able to vote effectively. You need to know about this stuff. And what we're doing here is we really are studying the matrix. After we develop a strong sense of where we are on this show in terms of what is our audience going to look like, what do they want to see, we're going to be doing our own series of financial red pills. We have the social red pills. We have the political red pills. We have red pills in relationship, but we are yet to develop what is the truth? What will be the equivalent of the red pill in finance? And what are the parts of that? And if you're concerned about that word, don't be concerned about the word red pill. What I'm just saying is I'm not talking about other movements and other people. I'm talking about the matrix, okay? The original red pill. We're going to learn the truth about this global finance, and further downstream from that is politics, because politics is derived from economy first. That's where we're headed. But okay, that's 8 minutes, and let's just jump into the news because there's a lot of it. I'll start us off with a TikTok video tonight. Europe is on fire. And this is just from July, but it's still, I love these visuals because they give you so much. I'm all about context, okay?
Europe is on fire. The economy is in tatters.
Okay, so you should be able to read it. This is Europe's inflation, energy inflation, okay? In this area here, there was actually some deflation. The prices were going down, and you can see in the top corner here, this is December 2020. So we're going back a few years. Let's jump in there again.
Europe is on fire. Europe.
So that's just an excellent visual there of the energy prices all throughout Europe. And the Netherlands is looking especially bad. UK, and I believe the BE here would be Belgium. But imagine what that's doing to people's standard of living. And another area that I want to go in, but it'll be too time consuming. But what really energy needs to be on our radar. A couple things that absolutely must be on our radar if we're actually going to really understand this shit is we have to understand how energy is probably the most important driver of economics and politics. It's all about energy, and very, very close to energy is the debt. And usually people, when they think of economics and politics and finance, they're and even personal finance, honestly, is they're thinking of the stock market, and that's a complete red herring. That's a red herring, and it will also be used as a what's the other word? It'll be used like as a scarecrow to beat up on other times. It's really all about the debt market. It's about the bonds, and we're gonna keep digging into. And this is the perfect opportunity. So I don't need to say any more than that. One thing that I wanted to show you here. We have a tweet from a gentleman named JT, and I had not known this. This is very interesting. This is going to set us up to go where we're going here. For 2 years, the Fed screamed that inflation was going to be transitory. They lied. Now these same idiots are tightening at the fastest pace in Fed history. They are either incompetent, delusional, evil, or perhaps all three. The Fed is either going to pivot or crash it all. And so I don't know, like I don't think I necessarily disagree or agree with his commentary, should I say? But it is interesting to know, yes, we are hiking very fast. And if you followed this show at all, or what I've talked about in regards to the dollar milkshake theory, we know how much pressure that we're putting on other countries around the world that are carrying American debt. When we do these hikes, people are trained to just think of America only, and it's not just America. This is putting pressure on everyone that carries American debt, and it especially puts pressure on other countries because they don't have as easy access to the dollar as we do. Okay, onward. I have a meme here from Deso Games, is one of my favorite Twitter accounts. Gathered concern. I just thought this is so funny to look at, and we'll see why we're concerned here. And we'll see. We'll have a good look at all the concern. Okay. This is the concern. This is the big news. I want to see what that notification is. Let's see. Oh, someone was just liking one of my tweets. Okay.
From the Bank of England just now.
This here is the concern. This is the biggest news of the day. And if there wasn't so much craziness going on with the pipeline and politics and all this stuff, this is absolutely huge news, and people just don't have the foundation to understand how impactful this is. So let's watch.
Jane, with a rather extraordinary statement saying that they are planning a gilt market operation, which is an intervention from the Bank of England, they say, to try to restore orderly market conditions. Let me just read out part of this statement, literally just in the last few minutes from the Bank of England. They say, as the Governor said in a statement on Monday, the bank is monitoring developments in financial markets very closely in light of the significant repricing of UK and global financial assets. The repricing has become more significant in the past day and is particularly affecting long-dated UK government debt. Now, what they're talking about there is essentially part of the thing we've been talking about recently, the yields on government debt, which have spiked up to the highest rate that we've seen since the financial crisis. The statement goes on, were dysfunction in this market to continue or worsen, there would be a material risk to UK financial stability. This would lead to an unwarranted tightening of financial conditions and a reduction in the flow of credit to the real economy. So essentially saying that this could, well, we're already seeing it, aren't we? You were just talking to Ian about this, the fact that mortgage lenders are pulling some of their products because of what's happening right now.
All right, that's enough. There was a lot of language in there, a lot of words. But basically, the UK was having a tough time selling one of its important bonds. It's called the gilts. And because they weren't able to sell them, the rates started to rise rapidly. And there's supposed to be a point where in a free market, in an unmanipulated market, those rates rise to a certain point where it becomes a very attractive buy to someone that wants to invest in bonds. But the problem is that when those rates get too high, they can't afford to pay them. They can't afford to pay those rates. They don't want a fair market value. They want a low rate, something they can afford. And what happens is these higher rates, or their inability to sell the bonds right now, is impacting the pension funds. So basically, now you have the Bank of England stepping in and buying these bonds from the government to keep them solvent. And it'll work for now. It can work for now. That's what many countries are doing, but there's long-term consequences. You're not getting richer by taking money in one pocket and putting it in the other. And that's what these countries are doing. And if this was a household debt, you've come up with a temporary solution, but you don't have a permanent solution. And that's all that translated there. Is I gave you the gist of it. Here we have a tweet from Wall Street Bets. And here's our dollar milkshake theory in play again. More proof. Canadian dollars, Australian dollars, euros, British pounds, and Japanese yen all sinking. He writes, everyone's fleeing to the dollar, and there you see it. And what we know, what I've explained, what the truth is here, is that it's not that they're necessarily fleeing to the dollar, and maybe some are, but it has a lot to do with those higher interest rates. They're scrambling to get dollars to service their debt. Maybe some of them feel safer in a dollar, but I think it's equally that, or if not more so than they're trying to find a safe haven in the dollar. That's my opinion, and you're welcome to argue with it. I just picked this I just picked this article real quick, and hopefully it accomplishes its job. I want to explain how when the Fed buys bonds, so usually the bonds are sold to the open market, and the Fed in this case is a central bank. When a central bank buys bonds, it causes inflation, okay? How the Fed bond binge predictably stoked inflation. Back in September 2020, the Fed's preferred inflation gauge, the core PCE, was running 1.6, and the Fed chair, Jay Powell, was worried about disinflation. The Fed bought up $87 billion in treasuries and $34 billion in mortgage bonds that month as part of an ongoing strategy to push inflation up. So they were trying to get inflation up because on the other side of inflation is defaults, right? And so they were trying to get money out into the economy, and they were doing that by buying bonds from banks. The banks sell the bonds, and the Fed's buying them up. Usually the public's supposed to buy them up, and the Fed, as the central bank buying them up, it causes inflation. Why? Because the central bank can just buy them out of nothing, basically, and that creates a whole lot of money. When we buy a bond, we have to have worked for the money, or we would have to have an income generating business. But the Fed, on the other hand, they just create the funds and they give it to the bank. Okay, so let me keep reading here. Many thought the bond buying was wholly insufficient and called for more fiscal support to avoid Japanification. And so we did see Japan never really raised rates. They've been practicing what they call modern monetary theory for years and years now, and that is where their central bank is buying all the bonds and supporting the government in that sense. But we disagreed as predicted on the basis of the Fed's experience with bond buying during the great financial crisis, the GFC, that the Fed's COVID buying bond program would push inflation past 2%. So the argument is that the bond buying is going to push it even much higher than 2%, and they were aiming for 2%. We were off for a few weeks, but core PCE inflation passed 2% on March 2021 and kept climbing from there. So they were trying to get a little bit of inflation, but it got out of hand, okay? So what did we see in 2020 that suggested higher inflation in the making, and why does it matter going forward? Consider first, the Fed buys bonds to boost growth of inflation. Bond buying, or quantitative easing, there's that word, quantitative easing, works via the so-called credit channel. That is, it encourages banks to lend more. When the Fed buys bonds from the banks, their cash reserves at the Fed go up. And as the liquidity cushion expands, banks have greater incentive to lend. Cheaper and more abundant credit encourages more spending and investment. So we can stop right there. Long story short is, when the Fed buys those bonds, they created a whole bunch of money. And the banks and the Fed, they're all sitting on cash that they created. And the banks are in the business of lending money. That is their business. That's what they're there to do. They want to lend money. And especially if there's no consequences, like if they make bad loans and the bank, this is how a bank goes out of business. They literally have a business of just creating money out of thin air in the form of loans, and then they collect the loan back with the interest. And that's the business, the coolest business in the world. They barely got to do shit, right? But when they're sitting on all that cash, they're like, yeah, let's lend it, because that's what they do. And the Fed is giving them a way to just have all this cash. They call it liquidity and quantitative easing and what do they call it? Financial cushion, liquidity cushion. These are all euphemisms. They have a bunch of money and they have a lot of incentive to lend it out because there's so much of it. And that's all I wanted to demonstrate. I thought this was a powerful tweet. Robert Smith writes, jaw-dropping quotes on how close we came to catastrophe today. He's talking about England. Senior banker describing the leveraged unwind in the gilts as coming close to triggering a Lehman moment. Asset manager accusing the Bank of England of ignoring calls to intervene sooner. So they're already fighting over when they should have reversed course and how soon and whose fault. The best way I can explain it is they're between a rock and a hard place, and no matter which way they go, it's going to be trouble. You want the bank intervening, creating inflation, or you want them not intervening, and then you get defaults. Instagram is now fact-checking CBDC memes. And so that is a little bit unrelated. I think I meant to have that slide in another part of the show, but so nevertheless, here we are. Now we have Facebook and Instagram fact-checking posts about finance. And in this post here, it's a little tough to see. Got a little bigger here. It says, hey, cool, government is trying to make my life easier with a digital currency. And it's like, you got a digital credit score. Every transaction is documented. They have access to your money. They can freeze your funds. It's centralized. There's no privacy. There's no anonymity. All your movements and actions are traceable. Banks have full control of every penny you own and your vulnerability to state and sovereign actors. And there's more things I could add on to that, right? And you have Instagram Zuckerberg over here. Not so fast. We're going to fact check you. And we've already seen how they are. We know how they are. This could be accurate. This could be wholly accurate, top to bottom. And they'll find some little tiny piece to quibble over, so they can slap that warning on your post and do more. And then your friends that are normies, that don't even understand like the most basic things, they open up your post and they're like, oh, they're sharing fake news. They're sharing conspiracies. That's how it works, right? They just want to get that little banner up there to cast doubt. That's the manipulation. That is the psycho in the psycho silver. Okay. And we're going to be attuned to this manipulation. We're going to be hyper aware. We're going to see it everywhere we go. This is the Matrix. And in the Matrix, they just change the rules on you. And then they pretend that they didn't do it. And we saw that with what happened with this thing, right? I mean, now we knew we were right all along, but they fact check us, and they put their little banner on there and tell you wrong just long enough to push the herd of people in the direction that they want to go. And as soon as you get 100 people moving in that direction, the next 1,000 will follow, right? Because that's how humans are. Okay, onwards. And we did see this tweet already, didn't we? I believe we did. Next tweet. These were really excellent tweets. I've never followed this gentleman before, but his name is, how do I say his name? Daniel LaSalle. I'll say it like that for now until I'm corrected. Daniel LaSalle here writes in his book, Escape from the Central Bank Trap. I explained a few years ago the US dollar vacuum effect, the mistake of copying the Fed without having the global reserve currency, and the trap after disguising risk with monetary laughing gas happening now. That is what he just described there. That is the dollar milkshake theory. He's calling it a vacuum. So he was on to this game already too. And what he's saying here is we're in deep shit, and the monetary laughing gas is just it's the anesthesia that the UK, the Bank of England, just chose anesthesia over the pain that is needed to correct their economy. That is when they reversed course and prevented those defaults. That's the anesthesia. The honest thing, what they must do. If someone had the balls, no one has the balls. No one has the balls. I don't think people are too soft. They wouldn't understand. But if this was a household, this is where the dad would need to take charge and say, hey, we're going to feel some pain. We might have to move out of this house into a smaller house. We might have to sell something. We got to make some changes. And they need to make changes to a lot of these programs. And if you do try and do that, they're going to vote your ass out. And they can't be having that. Next slide. I got another tweet from Daniel LaSalle here. He's got some really fire. This man had some fire tweets today. I'm happy to give him a follow. Daniel LaSalle writes, liquidity injection means printing money. Yield curve control means printing money. Anti-fragmentation tool means printing money. Anti-inflation spending package means printing money. Yes, when you do understand the basics, it becomes very clear very quickly that they use all these euphemisms. They use all this jargon. Oh, this gentleman, Jamie Small remarks, he forgot QE. Printing money. Next tweet. Here's a tweet from, and I love following this Michael Gayed. Michael Gayed says, England is Bear Stearns. Japan is Lehman. Few understand this. And so I don't know if we've necessarily had our Bear Stearns or Lehman moment. If you don't know what he's referring to there, those are the banks that collapsed in 2008 and triggered the crisis. They collapsed because they were insolvent. We'll find out. It very well could be. We don't know. We don't know that when these defaults happen or they become in danger of happening, there's a ripple effect that they don't tell us the consequences of until far after it's already over. So we could have had a complete collapse yesterday, and it could already be cascading through the system, and we wouldn't know it. At least not for a while. And here's I wanted one more tweet from this gentleman because he was just on fire. Daniel Lassalle writes, whatever happens in the next 12 months, the Fed has made sure that the US dollar remains the world currency for another decade. This is the dollar milkshake. This is quite possibly one of the red pills of finance, okay? I followed guys like Peter Schiff and Kiyosaki, all these, even Ron Paul to some extent. And I always believed that because of the debt, the dollar was going to collapse. And it probably will eventually. But we are inflicting massive pain upon the rest of the world. And when we inflict that pain with the dollar debt, it gets further entrenched, just digging in deeper. The hooks of the dollar, they're like claws, and they're just in. And the more the struggle, the deeper those hooks get. That's what's happening. And so how it comes to a conclusion, I don't know. We do have the BRICS nation that are pushing back, but their control of they're just not nearly as big to be able to do anything about it yet. And so how they eventually stand up to this system. And the problem is that there's not really another currency that's strong enough. You would need another strong currency issued by people that are trustworthy. The only thing that I possibly think could really put an end to this is, and this is possible, this is real talk right here. This is real talk. A complete crisis in the commodities sector. In other words, energy scarcity, silver scarcity could be coming. Gold, nickel, platinum, water. Nothing will bring people back to earth and cause them to switch an economic system where those types of real world things start putting pain on people. And then we'll be singing a different tune very quickly as a globe and even America. Here's another tweet from Michael Gade. Said it before today, saying it again today. We are morphing from an inflation crisis to a credit crisis. Yes, we are. If you don't believe me, you might want to look at why the Bank of England intervened. Wake the fuck up. Depending on which side of the ball they're gonna play, are they gonna inject liquidity? Is the Fed gonna buy bonds? Because then you get inflation. Or they're not going to do it and allow things to default. That's when it becomes a credit crisis. We will, right now, the Fed is raising rates. As we saw earlier, they're raising rates quickly. I do believe we will have a pivot and they will go back to the quantitative easing, or I don't know what I guess that's the word they're still using for it. But when the Fed does resume aiding the US and printing gobs of money, we will be back on the road to hyperinflation. And there's some people that suggest that we don't have more pivots to do because now they're just going back and forth between one or the other faster and faster. But we may very well be running out of moves. Here's a tweet from my favorite account, Grand Marty. He writes, the pending crisis will be talked about in 1,000 years. That's the only positive. 2008 was a small ripple. Biblical would be the perfect description for what's to come. God bless and Godspeed. Well, that speaks for itself. And I'm not really interested in, I've learned my lesson on this. I've learned the hard way. Not to be a doom and gloom guy, like the end of the world guy, because the world never really ends, right? And then you really fuck yourself in a big way when you think like that, because you need to be making moves in your life as if the opportunities are going to come. And when you're in the mindset of everything's going to come crashing down and come to an end, you are in the wrong state of mind to be able to do anything good for yourself. But I do think that it's important to be aware of how serious this is. Very serious. The situation we're in with the global finance. And so that's why I add that. But I don't necessarily agree. I'm not going to live like that. It's already been years since we knew that there was going to be we knew the storm was coming, right? What's that? Oh yeah. You were watching a movie. Could be just that. Okay. On to the next. We're about halfway through. I'll try and keep it under an hour. Let's keep going. Here we got a tweet from Jeff Stein. Jeff Stein writes, the CBO report, the poorest half of America, 150 million people hold only 2% of the country's total wealth. Wealth of the top 10% has grown markedly since 1989. That tiny little line at the bottom of this chart is half the country. And it's a little tiny line. Bottom 50% not doing too well. I have no interest in being on that bottom percentage, and I have no interest in associating with people that are on. I mean, I'm sure like many of these people have other things to offer than money. But like I remember Kanye said, this is about something else. I won't say what he said it about, but hopefully you recognize the quote. Looks like a choice to me. Being on the bottom that long. When you're with half the people there, looks like a choice. I'm not choosing that for myself. But this is reality, right? I do believe that I saw an interesting... No. Okay, we haven't checked in on the debt clock in quite a while. Been a long time. So here we got in the top corner here. Pull up our little tool. Let's do it in yellow. Yellow should stick out good on this. Total debt. We're on the cusp of 31 trillion. And again, it's all about context, right? So for context, 31 trillion, this is we'll just call it 5 trillion. That's how much they're able to tax in 1 year. Okay. So, that's 6 times as much. It almost sounds reasonable. But the problem is the Social Security liability, 22 trillion. Medicare liability, almost 35 trillion. US unfunded liabilities. Oh, this is behind my... Let me move out here. This is the problem here. Projecting it out, and the debt's getting more expensive. And so when you see that, you understand the seriousness. It's in what's the word? It's unsustainable. It is inevitable that this needs to be rearranged in one way or another. It cannot continue like this. And I'll point out over here the gold to silver ratio is $1,214 per ounce. That's how many dollars to ounce. Gold to did I say gold to silver? I meant to say dollar to silver ratio is 1,214 per ounce, and the dollar to gold ratio is at about 9,000 per ounce. What other interesting stuff can we have a quick look at over here? What is the energy output button? This ought to be interesting. Let's click it. We're doing an experiment. I've never looked at this before. Maybe we find something cool here. Energy output. Pretty interesting. Let me move myself out of the way again. China nearly double the amount of BTUs, world energy consumption. So China is consuming nearly double the United States, but you know their population is far more than double. Natural gas, crude oil, coal, nuclear. I'm surprised nuclear. So right here it's showing us that nuclear is somewhat comparable to coal, but it looks like it's less efficient at the same time. Interesting. Hydroelectric, biofuel. The real, if you wanna hear a scary story, the real what's the word? The real doomsday scenario is energy. And we probably will want to do a show on that one day. Long story short, the return on investment in energy is going down. It's going down every year. And it appears as we have tapped many of the proven oil wells. And so those are the oil wells that we can tap into. But the problem is that it's a much lower return on investment. And so that can have all kinds of impacts upon what the future looks like going forward. And we will have to basically do a whole show about that because it's really interesting. It seems like it's true. I did get I got the fuck scared out of me by a movie and a book called Collapse by Michael Rupert. And this was many years ago. And we all were getting into the peak oil theory. It never happened. It turned out it made sense. The way the theory made sense, but it was like another Al Gore, except this guy was way cooler than Al Gore, but it was like another inconvenient truth where some people saw it and got concerned, but it didn't turn out that way. And I know the SS Rocco report on Twitter that's a Twitter account that I've showed many times is all about the energy cliff. And if there was an energy cliff, we would not be told about it, okay? I wanted to show you this real quick because there's a couple interesting things about this tweet or this Reddit post here. Someone on Reddit, Paulo Ponzi, writes, "This is not some shitcoin or Ponzi stock. This is UK government 40-year bond. Imagine being close to retirement and buying this close to 100 in December last year because you're told stocks are too risky, and now it's sitting at 25. So I'm not in the head of this person, and it does appear that they do not know what they're talking about, that they do not know how bonds work. So many of these people that are trading stock, and a lot of them are pretty intelligent and they're learning how to analyze, but they're gamifying it. They're not doing it as an investment. It's a speculation. They're turning into a game, and some of them are very good at it. And I am certainly willing to admit many of them are smarter. They're very smarter than me even. But they do not actually understand how they don't understand how economics work. And just the way that he's wording this post makes me think that he's not actually understanding what a bond is. So this chart here is not the bond. The whole point of the bond is it pays out a fixed rate. So you're basically entering into an agreement with a government. And the government's supposed to be the most solid entity you can make an agreement with. And they tell, we're going to pay you this fixed amount. But what he's looking at right here, I believe, is he's looking at the change in the price of a bond. And the prices of a bond can change. Prices are going down, which means the yield is going up, okay? But there's secondary markets, so people can still buy and sell them after they've already purchased theirs. But you don't know what the future is going to hold. So there was people today that probably thought they were going to get a higher yield on a bond if they bought from the Bank of England. They're like, oh, the yield is high. It looks good. I think I want some, but it's going to go higher. And so they're saying, oh, I'll wait till tomorrow when the yield goes even higher. Well, that's not going to happen because the Bank of England stepped in and they're going to put a cap on the yield. And they're going to they're going to put a cap on the yield by buying a bunch. I hope that makes sense. But here's someone that doesn't appear that they understand, or if I'm not reading that correctly, feel free to correct me on that. But I'll show you, there was another interesting post. Someone responded. Here we go. This user replied right here. I think the confusion is about the bond's value on the open market versus their yield. Saying retirement fund lost 75% of their value does not make sense if those bonds are still yielding at 1% annually. The comparison to crypto is only if trading bonds, not buying bonds, and bettering on the market rates of bond changing, which defeats the purpose of using bonds for safety. At least that's how I understand it. And that's exactly it. So I don't know if this person was commenting like on trading bonds and trying to make a bunch of money. And that's a whole other, it is such an interesting thing. Like all these instruments they use to gamble on bonds and use bonds and leverage. It's really ugly and it's very serious because these bonds are the biggest debt in the world and they're supposed to be the most secure debt. And if you listen to people like Greg Manarino, for example, who I appreciate, he's taught me a lot. It's not the stock market that we should be worried about. It is the bonds. It's the debt market. This is where the big money is. This is where I heard a podcast the other day where they were asking like, well, why do even people buy bonds? Who would buy bonds? It's stupid. You can get 1,000x on butthole coin. Why don't you buy butthole coin? You have to understand, people with big money, the size of those shit coins is not big enough for big money. Institutional investors, private investors with like, they're doing super well. The wealthy elite. Crypto can't even hold their amount of money. It doesn't make any sense. They need bonds because they need an entity with enough size to take on their loan and be able to safely pay it back. And crypto is not that. Like, it's fine for someone that wants to speculate, or you have like a good amount of money for an average person. But if you're wealthy, you need the bond. You don't even know what to do with there's not even like good things to do with your money, because starting a business is very time intensive. And so that's the best thing you can do is start a business. But after you have businesses that are generating income and you have money coming out of your ears, you can go to the stocks and they're less safe, like everyone kind of knows. And now right now the bonds aren't safe, which is crazy, but the bonds always used to be the safe place. But they can hold, the bond market is where you can hold big money and earn interest on it. And that's why people use bonds, especially wealthy people or institutions, like we mentioned, the pensions. There's many other retirement funds and even mutual funds. They get super huge. They need bonds. Okay, I went off into the weeds there a little bit. Next thing here.
Morning. We're down by between 3 and 4.5% generally across these markets.
Let's talk about the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%.
Dow at the same time has fallen about 18%.
The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Two-year no yields went from 190 to 166 in the blink of an eye.
On the NASDAQ, everything and more has been completely wiped out.
It was the worst day on Wall Street since the crash of 1987.
From the financial capital of the world, the opening bell is going to ring in 5 seconds, and to be honest with you, we wish it wouldn't.
Traders here working the phone say a lot of their customers are freaked out, waiting to see how low the Dow will go. They're focused on the Dow, not so focused on OPEC. Yes, OPEC did cut production by 1.5 million barrels per day.
Really, you're seeing just broad-based declines across all of the major technology sectors. Apple's under pressure, Yahoo down 8.5%, Cisco 6.5%, Research in Motion 10%.
And we're not getting the bid wanted. We're not getting the stop trading, and we see where the buyers are. We're just, every day they're pounding it.
The heightened financial turmoil that we have experienced of late may well lengthen the period of weak economic performance and further increase the risk to growth.
Can't look at it after you buy it. It's so horrible.
But we've had an 8-day losing
So
streak for the Dow
horrible.
that in percentage terms puts it on par, close to the loss suffered in that crash in 1987, close to that percentage loss those 2 days in 1929.
What started in America last year has now spread to every part of the world.
We're down 9% today. The Xetra DAX over in Frankfurt is down by 9%. The Paris market down by 9%. Austria, which was briefly suspended earlier on in the day, is down by nearly 11%.
This market is as volatile as you'll ever see.
Traders saying this is the craziest day they have ever seen in these markets. Veteran traders saying they've never seen anything like it. The movement in oil prices so fast, so
Seconds to go until the start of trading at the New York Stock Exchange, and stocks are set to kick off lower, a whole lot lower.
eBay is down 6.5%, and really you're seeing just broad-based declines.
Do we see a repeat of this? Does an anniversary matter? Are we gonna have a crazy day tomorrow? Here we have a headline from Breaking Market News. U.S. officials. The U.S. Treasury is watching the UK turmoil with increasing concern. And I did like this Ponzi Finance tweet underneath that writes, Europe could be facing a hyperinflationary scenario if their central banks continue the madness. And that is what we've been saying. In crypto news, I did see this interesting tweet from the Happy Hawaiian, who's doing some charting for us. It's got some interesting charting for us here. There is this looks like some sort of log scale on the 1 month. And I suppose if it does touch the bottom band of this is going to go maybe 7,000. Long-term scale. And this looks like a series of bear flags. It looks like bear flag after bear flag after bear flag, and a similar drop like the ones we had before after this current bear flag. While the bottom of the band there is at 9,500. And I'll just let that stand alone. You make of that what you will. And we did already see this tweet. So I got our last few slides for us here before we call it a day. Michael on Twitter. Please follow Michael. He gives us excellent updates on the silver situation. Michael writes, large Comex silver withdrawals continue as vaults drop 1.18 million ounces. Vault totals at lowest since June 15, 2020. Registered totals at lowest levels since November 1st, 2017. Open interest now equal to 205% of all vaulted silver and 1,511% of registered silver. That is the most important thing you're going to hear today. The Bank of England pivoting is huge. This is equally as big to me. And if you are a silver stacker, you got eagle eyes on this Comex vault. And again, this is another fucking huge day of the silver being drained out at an incredible speed. The vault going down 1,185,000 in one day is monumental. It's I've said this before, but it's I mean, what is the right language? Like, what could we compare to that? I don't know. See, I'm at a loss for words. This is astonishing. This is a rate of decline, as I've mentioned before. This is a rate of decline that leaves the vault empty in a couple months. And then what? I guess we have to wait and see if there's silver out there somewhere that finds its way in. But I don't think that's going to happen, because if you study this market, then you understand that it doesn't make any sense to sell your silver at these prices. And everyone's thinking the same thing. And honestly, I don't know why the miners even do sell their silver at these prices. I guess it's because they have to rely on banks to conduct business. And if they were to withhold their silver, they would put them at odds with the banks. And maybe that's a bad business decision. But this is crazy. And as we will see, it is not just, it's not just silver. It's gold, it's platinum, it's nickel. I hope you do know something about what happened with nickel over the summer. There was a default on nickel, and that's a whole other story. But again, it's one of these metals that you can't just create out of thin air. So let's read this tweet from Deso here. Deso got a vision. He writes, still watching the LME, but not much is going on. Aluminum just doing what it's doing and slowly decreasing again. Copper is the only thing refilling on lower prices, it seems. Lead is slowed its drop at a new all-time low. And who knows what nickel's doing, because now it's tough to get information on nickel. However, zinc, I don't know what happens here. Zinc is another energy intensive metal, and it could be nickel or zinc that really signals to the rest of the world what is about to happen in gold and silver. If the zinc runs out first, then maybe there's a run on the metals as it dawns on people that these are finite substances that take energy to refine, and they're indispensable, universally useful. And here you have the zinc disappearing off of the LME, and that is there's no mistake, there's no other way to read this chart except for as much as it's gone down, it's going to be completely gone fairly soon here. And that is the same story with silver. Okay, on to the next. Here's an interesting post from Wall Street Silver. This gentleman had posted before about having some difficulties withdrawing his money. Gotta fly. He writes, I posted a couple days ago that I was arranging to get my cash out of the UK bank. It was a 5-figure amount, and I feel safer having it physically in my possession than in the bank holding it. I explained. I explained I was being messed about and the bank was dragging out the process. Some of the comments seemed to disbelieve what I was saying and calling me out as some kind of a liar. I just had a phone call and the cash will be ready mid next week. So for the detractors out there, that's a week and a half to get my cash out. He writes, be warned, UK apes. I'm adamant that the banks are terrified of a bank run. I'm just one of the first. I believe it. I believe you, sir. And this is an excellent comment. Refusing me would start a stampede. Yes. So they're in a precarious situation. It does make sense that they are going to drag their feet, but not say no, because that's quite a story. If that happens to you with any of your stuff, they refuse to give it to you, you're going to tell every single fucking person you know, and at least half of them are going to trust you. And they're going to say, holy moly, I better get my money too. So they would be starting a stampede by refusing. But if they drag their feet and maybe blame him and I'm sorry, this and this, while they accomplish not letting him take his money, at least not quickly, but then they don't cause a panic either. All right, we're bringing this home pretty soon here. Here's a delusional tweet by Barry Silbert. Barry writes, Bitcoin is about to become the safe haven asset, nowhere else to hide. That is delusional. Is it possible? So my mind is open. I have an open mind, and I know that I can be wrong, but that is just delusional thinking. What is, I have a sound effect for that crazy delusional thinking.
Have you ever wanted to believe in something, even though you knew it couldn't be true? Did you ever want to believe it so bad?
They just want to believe it so bad. Peter Spina underneath writes, the drop gold campaign was poorly timed. I hope you're more prudent than those TV ads with all your wealth. Please don't scare us with everything in Bitcoin. Jim Forsyth underneath that writes, this guy is a clown that started that. I've always suspected whoever started that campaign works for the banks. And this is an important comment. This is the original comment that I wanted to show you here. John Wick writes, yet there is zero data or evidence that this is happening or starting. Instead, we have lower prices. We can't break out of local resistance. And it seems like we've seen this story before. Very true. Matt writes, LOL. Peter writes, I nearly gut laughed. These guys are teasing him. Here's an interesting headline from Zero Hedge. Zero Hedge writes, NFT trading volumes have collapsed 97% since the January peak. And I did find a related TikTok video. Let's have a watch here.
This NFT. This is Doodle Dragons, and they just pulled off one of the most bold rug pulls ever. Doodle Dragons was a verified Solana NFT collection. They vowed to donate all profits to charities helping animals on the brink of extinction. Everything seemed to be going great, and they tweeted they would be donating $30,000 to the World Wildlife Foundation. However, on the official Twitter account that's now deleted, the founder announced he had a change of heart and tweeted out, actually, fuck that. Our charity will now be my bank account. See ya, nerds. This is Doodle Dragons, and they just
see ya, nerds. Oh, man. We are nearly at the end here. We did already cover the silver squeeze in another, let's see if we have any new information here. Well, this is interesting. We did see that the total vault drain on the day was 1,185,000 ounces out of the vault. But we do see these vaults each of these vaults taking a substantial hit. MTB, can't remember what that stands for, but they lost 4% of their silver. That is amazing. IDS, 3.8% of their silver, and Brinks 1.4% out of the vault. Hardly anything arriving to the vault, so it's not like as if it's being exchanged and you have your up days and your down days. It's just disappearing. I got one last. This is probably one of those videos or potentially one of those memes that Instagram would like to see banned. Instagram and Facebook. Let's have a look at this real quick.
Of if we were to pursue a CBDC, it would at a minimum have the following four characteristics. First is intermediated. Second is privacy protected. The third is identity verified. So it would not be anonymous. It would not be an anonymous bearer instrument. And fourth is transferable or interoperable. So we would be looking to balance privacy protection with identity verification, which has to be done, of course, in today's traditional banking system as well. We think that there are four characteristics.
All right, so the CBDC we do believe is the end game, that it's coming one way or another, but how convenient would it be for the CBDC to arrive just in time to save us from a catastrophe? So will we have a catastrophe, or is everything just going to stay nice and peachy it looks like it might get a little tough, but it doesn't. And then they give it to us and we accept it anyways. Doubt it. I doubt it. So we will conclude our show right there. We're at 1 minute and we're 1 hour and 5 minutes. I do appreciate you. I believe there was really good information in this show, and we are building to a climax. World events are so interesting right now, and every day we're going to have so much to talk about. And I want to be here for you every single day, giving you valuable content, valuable analysis, helping to explain these some of these complicated news articles and tweets, and to help you by curating all the best information and distilling it down into a crystal clear, understandable video that gets you informed. And we're gonna do it on your level. You can't do it on someone else's level, and some of these levels are way too. Don't get me wrong, these guys are very smart, but they can be very wordy and use all this fancy language. You know, one of the signs of intelligence is you can break things down into an understandable language. But I do believe, once again, this is part of the manipulation. This is part of the matrix. This is part of the psychology that puts up barriers between you and understanding finance and economics. They don't necessarily want you poking your nose into that stuff, but that's what I'm here to do. Is I'm gonna poke my nose directly into these places where it doesn't belong, whether because I don't have the education, or I'm not qualified, or I'm not rich enough to be able to comment on economics or finance. Well, I'm gonna do it anyways, and the show is gonna get better and better. I'm looking forward to having guests. We're gonna have guests, and we're going to find ways to make it entertaining, make it funny, make it cool. We're going to use swear words. This can be a great show. We're just barely getting started. I do appreciate you for watching all the way through. If you listen all the way through, you're a fucking stud. And I love you. Thank you. I will be back tomorrow. And you have a good night. And I appreciate you. You have a good morning or good night wherever you are. Take care. Bye.